I was sitting across from a couple last spring, late 30s, both working, two kids, solid household income. They had come to me because they wanted to talk about buying a bigger house. Their current place worked when they first bought it, but with two kids and the way their lives had grown, they needed more space. This was not an unusual conversation. I have it regularly, but when I pulled up their financial picture to see what they were working with, there was a number that stopped me. Their combined outstanding debt obligations had grown significantly over the past 18 months. Not credit card debt exactly, not a car loan. Buy now, pay later balances, dozens of small purchases spread across multiple platforms. A mattress, a television, Christmas gifts for the kids, a laptop for working from home, a few appliances after they moved into their current place, some things for the kids' rooms. Individually, every single one of those purchases had seemed completely reasonable at the time. Most had been 0% promotional, some had been paid off on schedule, several hadn't, and when I sat down and added it all up across the accounts, we were looking at several $1,000s in outstanding BNPL balances that had been sitting in the background of their finances like a slow leak neither of them had noticed. They did not think they had a debt problem. They thought they were managing fine. They were covering every minimum payment. Nothing was delinquent. And in a narrow technical sense, they were right. They had not missed anything, but the balances were showing up in their debt to income ratio. A couple of hard inquiries had appeared on one of their credit files, and their mortgage options were meaningfully narrower than they would have been 18 months earlier. They were confused. They had done exactly what the product told them to do. They had made every payment, they had not gone crazy spending on things they could not afford. Nothing had gone wrong in any individual moment, and yet here they were with a financial picture that was meaningfully more complicated than they expected, and options that were narrower than they should have been. That conversation and the pattern behind it is what this video is about. Buy now, pay later has been sold as a smarter way to spend, a modern alternative to the credit card, zero interest, flexible payments, lower stress, and for a lot of people, that's how it feels right up until the moment it starts costing them something real. And by the time that happens, the individual purchases that created the problem are long since forgotten. The financial consequences are what stay behind, compounding quietly, and this is part of something bigger than just one product. The issue with BNPL is not unique to BNPL. It is part of a broader pattern of financial products that are designed to make spending easier, faster, and psychologically less uncomfortable, while slowly degrading the financial position of people who use them casually and repeatedly. Credit cards with rewards programs that encourage spending, auto-renewing subscriptions that accumulate in the background, BNPL plans that feel like nothing at checkout. Each one is a small thing. Each one is taken together with all the others. Part of why a guy in his mid-30s who earns a decent income, pays his bills consistently, and does most of the right things can somehow still feel like he never quite has enough financial breathing room, no matter how hard he works at it. The answer is not zero debt and zero spending. It's not even close to that. The answer is understanding which financial tools are working for you and which ones are working on you. BNPL, used the way it is actually used by most people, is working on you. Not because the company is evil, because the product is designed to reduce friction in spending, and reduced friction in spending means more spending. That is a problem that compounds quietly over time. Buy now, pay later has been sold as a smarter way to spend, a modern alternative to credit cards, zero interest, flexible payments, no impact on your credit. And for a lot of people, that's how it feels right up until the moment it doesn't. Because the financial product that looked like a convenience tool is quietly reshaping how lenders see you, how much house you can buy, and how much everything else in your financial life costs. And most people have no idea it's happening. Before I get into the mechanics, quick question for you. How many active buy now, pay later accounts do you have right now across all platforms? Klarna, Afterpay, Affirm, anything else? Drop the number in the comments. I'm actually curious because most people cannot answer that question off the top of their head, and that gap is exactly where this conversation starts. The NPL exploded during the pandemic, and it has not slowed down since. We are talking about a market that moved from a niche product to a checkout default across almost every major retailer in the country. The companies behind it, Klarna, Afterpay, Affirm, PayPal, Pay Later, and a dozen others trying to grab market share, have done something quite clever. They took the friction out of short-term financing. You are at checkout, you see a button that says 4 payments of $37, and your brain processes that completely differently than one payment of $148. That is not an accident. That is the entire business model. The smaller number feels more manageable. The time gap between now and the future payments makes the cost feel abstract, and because the first payment is often deferred and 0%, the purchase does not feel like debt at all. It feels like a smart way to buy something you were going to buy anyway. But it is debt. Full stop. It just does not feel like it, which is exactly the problem. The psychology behind this is not subtle once you understand it. Retailers and BNPL companies have done significant research on purchase rates and cart abandonment. Offering BNPL at checkout increases conversion, meaning more people complete purchases they might have otherwise abandoned. And it increases average order values, meaning people spend more per transaction when they can split the payment. This is not a coincidence. It is a designed outcome. The product is engineered to reduce the psychological friction of spending, and it does that job extremely well. That would be fine if people only used it for purchases they had fully budgeted for and planned to make regardless. Some people do. Most don't. Most people use BNPL because the payment feels smaller and the purchase feels more affordable than it actually is. That is a spending psychology problem dressed up as a financial product. And here's where it starts to interact with your actual financial life in ways that matter significantly if you own a home or are trying to buy one. The first problem is what it does to your debt to income ratio. When you apply for a mortgage, or try to refinance, or try to get a car loan at a decent rate, lenders calculate something called DTI, debt to income ratio. It's the percentage of your gross monthly income that goes toward debt obligations. Most conventional mortgage lenders want this number below 43%, and the lower it is, the better your rate and the more loan you can access. What counts toward DTI? Monthly minimum payments on any outstanding debt. Credit cards, car loans, student loans, personal loans. And increasingly, BNPL balances. Not all lenders check BNPL the same way yet, but that is changing fast. The major credit bureaus have been working to incorporate BNPL data more systematically, and the direction is clear. These balances are becoming more visible to lenders with every passing year, not less. Fannie Mae and Freddie Mac, which set the guidelines for most conventional mortgages, have been updating their frameworks to account for BNPL obligations. The product that felt off-grid from traditional credit is being brought into the traditional credit system. So that mattress you are paying off in 6 installments is not just a mattress payment anymore. It is a line item that a mortgage underwriter may factor into whether you qualify, at what rate, and for how much. The second problem is what it does to your credit score, specifically through hard inquiries and payment history. Some BNPL providers do a hard credit pull at sign-up. Most do a soft pull, which doesn't affect your score. But as BNPL providers push further into longer-term financing, larger purchases, 6-month or 12-month payment plans, hard pulls are becoming more common. A single hard inquiry on your credit file is minor, maybe a few points. A dozen inquiries over 18 months of regular BNPL use across multiple platforms starts to add up in a way that becomes visible to lenders. And if you miss a payment on any of these, even one, even by a few days, an increasing number of BNPL providers now report that to the credit bureaus. This is a significant change from how BNPL worked even a few years ago. The early marketing around these products leaned heavily on the idea that they don't affect your credit. That is less true now and getting less true every year. Equifax, Experian, and TransUnion have all been working to incorporate BNPL data more systematically, partly because lenders pushed for it, and partly because of regulatory pressure to bring these products into the same reporting framework as other forms of consumer credit. The direction of travel is clear. BNPL is becoming more visible in your credit profile, not less. One late payment on a $200 BNPL balance can hit your credit score the same way a late payment on a credit card would. The purchase was trivial, the credit impact is not. The third problem, and the one I see most often in practice, is the invisible accumulation. This is the one that actually worries me about BNPL as a category. Credit cards, whatever their other problems, are transparent. You have one statement, you see the total balance, you see the minimum payment, you see the interest charge. You might not like the number, but the number is right in front of you once a month. BNPL doesn't work that way. BNPL balances are spread across multiple apps, multiple platforms, multiple purchase cycles, each with their own payment schedule and billing date. There is no consolidated view. There is no single monthly statement that shows you the complete picture. You might have 3 active Afterpay plans, 2 Klarna plans from different retailers, and a firm balance from a larger purchase 6 months ago, and a PayPal Pay Later balance you almost forgot about. Each one is current. Each one feels manageable on its own, but you have no clear picture of what the total outstanding balance is across all of them, what the combined monthly obligation is, or what happens when 2 or 3 payment cycles land in the same 2-week window. The invisibility is a feature for the companies. They don't want you to see the full picture because the full picture is less comfortable than each individual piece. For you, as someone trying to build toward real financial goals, the invisibility is a liability. I want to tell you about a conversation I had with a friend, not a client, a friend, about a year ago. He is in his mid-30s, earns good money, pays attention to his finances more than most people his age. He mentioned in passing that he had been using BNPL for a while, mostly for bigger purchases, and that he liked it because he kept his credit card usage intentionally low. He thought of it as the smarter approach. I asked him how much he had outstanding across all his BNPL accounts. Right now, he paused. Said he was not sure exactly, probably around $500 or so. We actually pulled up each app together and added it up. It was closer to $3,000, spread across 4 different platforms, with 6 separate active payment plans at various stages. He had no idea. He is someone who genuinely tracks his finances and thinks carefully about money. That is how invisible this accumulates. Not through carelessness, through the structural design of the product, which presents each purchase as its own isolated thing and gives you no consolidated view of what you have actually committed to. Now let's talk about the mortgage piece directly, because that's where it stops being a minor inconvenience and starts being a real quantifiable cost with a number attached to it. When you go to buy a house or refinance your existing mortgage, the lender is going to pull your credit and calculate your DTI based on your outstanding obligations. If you have BNPL balances that are being reported, those add to your monthly obligation number. Let's say your base monthly debt obligation, car, student loans, current mortgage or rent, comes to $1,800 a month, and your gross monthly income is $70 to $500. That's a DTI of 24%. Very clean. Good options. Now let's say you also have $600 a month in combined BNPL minimum payments across various active plans. Suddenly your monthly obligations are $2,400. Your DTI is now 32%. Still potentially approvable, but your options narrow. Some loan products that were available to you at 24% DTI are no longer available at 32%. The rate you're offered might be slightly higher. The maximum loan amount you qualify for shrinks. And this is on top of any credit score impact from hard inquiries or late payments. 2 impacts happening simultaneously, compounding each other, each one making your mortgage more expensive or harder to qualify for. Let me put a real number on what this can mean. The difference between a 6.5% mortgage and a 7% mortgage on a $400,000 loan over 30 years is somewhere around $40,000 in total interest paid. That is the cost of a slightly higher rate, which flows directly from a slightly higher DTI or a slightly lower credit score which flows from a pattern of BNPL usage that added a few $100s a month to your outstanding obligations. The individual purchases that created those obligations were probably things you don't remember clearly anymore. The financial cost compounds for 3 decades. That is the actual math behind small payments, big problem. It is not one payment that costs you. It is the invisible accumulation that nudges your financial picture in the wrong direction at exactly the moment when it matters most. I want to be honest here. I am not saying never use BNPL under any circumstances. For a truly 0% short-term purchase you are going to make anyway, paid off before the promotional period ends, no hard inquiry. It is a neutral tool. The argument is not against the product in its ideal use case. The argument is against the way most people actually use it, which is almost never that. Most people use BNPL because the payment feels smaller and the purchase feels more affordable than it is. That is a spending psychology problem dressed up as a financial product, and the companies behind it have spent significant money engineering it to feel exactly that way. When you are in your mid-30s with a mortgage or trying to get one, spending psychology problems have compounding consequences. The individual purchase feels completely manageable. The pattern, repeated over 2 or 3 years, looks entirely different, and by the time it is visible enough to feel uncomfortable, it has usually already started affecting your options. The couple I started this video with, they were not irresponsible, they were not reckless, they had not done anything dramatic. They had just said yes to a lot of small things over a couple of years, each of which made sense in the moment. The problem was not any individual decision. The problem was the cumulative picture those decisions created. There is one more thing I want to address for people who are already in the market for a home or planning to be within the next 6 to 12 months. If you have active BNPL balances right now, the question is what to do about them before you apply for a mortgage. The honest answer is pay them off as fast as you can and stop using new ones. This is not complicated advice, but it is advice that requires actually doing something rather than just thinking about it. Active BNPL balances showing up in your debt-to-income calculation are a drag on your options. Getting them to 0 before a mortgage application removes that drag, and closing the accounts or simply letting them sit dormant removes the risk of a late payment damaging your credit file in the weeks before you apply. If you are not planning to buy a home or refinance for at least 2 or 3 years, the calculus is a little different. You have time to be more strategic, but the core principle remains the same. The financial flexibility you build by not carrying a bunch of small ongoing payment obligations is worth more than the convenience of spreading out purchases that you could afford to pay for in full. I hear the counter argument, by the way, 0% financing on money you would have spent anyway, while you keep your cash in a high-yield savings account or invested. That is a legitimate arbitrage, and I understand the logic. But it requires discipline that most people do not consistently apply, and it requires tracking multiple accounts and payment schedules with enough precision that nothing slips. Most people who start down that road end up with more BNPL exposure than they planned for, because the individual decisions feel low stakes and the cumulative effect is invisible until it isn't. What I actually want you to do this week is simple, and it takes maybe 15 minutes. Open every BNPL app you have, Klarna, Afterpay, Affirm, PayPal, whatever you are using, and add up every active balance. Total outstanding, not just what's due this month. Write that number down. Then pull up your credit report. You can get a free one at annualcreditreport.com and look at whether any of those accounts are showing up and whether there are any hard inquiries you did not specifically authorize. Look at your complete monthly payment obligations, including all BNPL minimums, and add them up. Then look at that combined number as a percentage of your gross monthly income and ask yourself whether you would be comfortable showing that picture to a mortgage lender right now. If the answer is yes, fine. If it makes you uncomfortable, that discomfort is telling you something worth listening to. None of this requires perfection. Nobody moves through their 30s without making financial decisions that they would have handled differently with better information. The point is not to feel bad about past choices. The point is to make sure the small, low-friction spending decisions you are making today are not quietly building friction between where you are and where you actually want to get to. Because that is the specific danger with BNPL. It does not announce itself. There is no moment where you sit down, look at a single number, and think, okay, this has gotten out of hand. Instead, there is just a gradual accumulation of small obligations that individually feel fine and collectively add up to something that matters at exactly the wrong moment. The wrong moment, for a lot of guys in their 30s, is when they are sitting across from a mortgage lender trying to buy a bigger house for a family that has outgrown the current one, or trying to refinance into a lower rate that just became available, or trying to access equity they need for something that actually matters in their lives, or when they are trying to refinance and get some breathing room in the monthly budget, or when a rate opportunity shows up and they cannot move quickly because their financial picture is messier than they realized. That is a bad time to find out that the 4 payments of $37 mindset has been quietly working against you. So start with the audit, pull up every platform, add up every balance, look at your credit report, look at the combined monthly obligation number against your income, then decide, with actual numbers in front of you and not just a vague sense that everything is probably fine, whether the tool you have been using is working for you or on you. That is a question worth 15 honest minutes of your time, because the answer changes what you do with the next checkout screen that offers you a split payment option. And those checkout screens come up a lot more often than most people realize until they actually start paying attention. That is where it starts, with just stopping and actually paying attention to the full picture, not just each individual piece of it. I will see you in the next one.